let's get a look at the fixed income space now. I'm looking over here because Jim's sitting with us in the studio from Big Securities, and Carsten Scott's still with me here as well. And Jim, great chance to check in with you on how the week's tracking so far in terms of, obviously, the RBA decision that we got. Was that a curveball for you? Did you get a surprise from that on-hold decision?
Well, I suppose I have to confess it was a surprise to me, but I think on reflection, I think it makes absolute sense. I suppose that's a bit of a cop-out, but look, I think it's a very interesting thing, and I think that people forget that monetary policy is a very blunt instrument, and the RBA has many other tools, one of which is serendipity. And I think, you know, the appreciation in the currency's played a big role in this, and I think what we've heard and what we've spoken about in the past is this sort of very aggressive growth happening in various sectors, and importantly, I think the export sector or the resource sector is very obviously impacted by higher Australian dollar. So I suppose that in effect has a more targeted effect, or can serve to have a more targeted effect over time than a monetary policy adjustment.
So it's like a quasi-rate hike already in some ways?
I think so, yeah. And look, you know, I guess I'm a big fan of the RBA's transparency, and I think that has been sort of questioned a little bit over the last few days. But you know, on reflecting on this decision, I think, and particularly the way that they voiced their bias in the statement, I think it still maintains my faith.
They clearly, though, failed to manage expectations, though. And that has to be a resounding failure on their part. If indeed they went public and gave every indication such that the money markets moved to price that in to the level that they did, if that was about managing expectations, how can you call that a success?
Well, I think they're certainly making the same noises. I think that the tone that they used in the statement was consistent with the statements that were made prior to the decision, I suppose. So I do see consistency there. I don't see that as being misleading. I think that the way I read that is that there will be a tightening next month. But I think it's important to note that there are these other factors that are put into the mix. I think, you know, one really interesting component of that is the Australian dollar. I mean, that has to have an impact on the longer term outlook for inflation. It's interesting. I mean, on the front page of the Financial Review today, we saw how that's Treasury forecasts were based around an 85-cent forecast for the Australian dollar. We've got a material move away from that. So I think that it is important that that's recognised in terms of the way that the RBA weigh up these decisions.
Well, I mean, realistically, though, in practical terms, what could they do short of wholesale slashing of rates to bring it back to an equilibrium?
Well, that's right. I mean, look, unfortunately, the Australian story is a good one, and that's being recognised sort of globally, both in terms of, you know, it moving to more of a reserve currency for sort of regulatory liquidity guidelines and a whole range of things. The resource story, it's something that needs to be managed.
I just wonder, you know, you talked about the fact that you think that the statement was consistent with what they've been saying, but they did go into the meeting knowing that for weeks markets were pricing in such a high chance, and by the end it was something like an 80% chance. There would have been an opportunity somewhere to come out and say, yes, this longer term story is strong, it's the biggest boom since the 19th century, but maybe there's no urgency because of the global situation. It seems like everyone just counted out the global situation, and look, maybe that was what they ended up.
I guess you can take it to the extreme, and where they can communicate their Glenn Stevens can communicate his absolute thoughts, but I'd like to think that it is a board decision and that the discussion lends weight to the outcome, and so I think that's what's happened here.
What about how the bond market's contributing to that Aussie dollar strength that you just mentioned?
Yeah, look, from what I can tell in my travels talking to players in the market, there is a great deal of foreign demand for Australian debt. It's becoming a reserve currency. As I said, you know, it's hard to pick a hole in the Australian story, and of course there's been a wonderful ride for the last couple of months for investors.
Well, I mean, and yet China shows every desire to be going the way of these beleaguered economies and buying their debts. What are they seeing? Is it just a search for yield, and that will always trump anything else?
In terms of the Australian dollars?
Well, I'm just wondering, I mean, how do you understand their push into Europe, which is still mired with huge refinancing issues ahead of it? You know, and they're expressing confidence in that.
Yeah, well, I suppose, you know, their markets are inextricably linked to the European market. I think as an investor, they have been overweight US dollars. I know that that's been changing materially. So I suppose in terms of their trading partners, they need to weight that accordingly.
Because they're a key trading partner for us. They're one of our largest. Are you not surprised that they haven't gone down the same route of being the main buyer of our debt to have more leverage when it comes to the other side of the fence story?
Yeah, well, that's a good point. I think probably the more leverage that Chinese can get is probably in the actual equity investments or in the underlying assets that they're actually sourcing. Australian bond market is a small market in global terms, and there are problems with being overweighted.
Sure.
And Jim, just finally, as quick as you can, because we are out of time, you're saying people buying 10-year treasuries at 2.5%, this is very dangerous. And we're obviously talking about the rush to position ahead of QE2. Yeah,
look, I think, you know, in I suppose market terms, I think the whole market is basing its strategy around front-running the QE2. So, look, I think people need to think about how that's going to be implemented, because it won't be $1 trillion up front. It's going to be over an extended period. And I also think it can be withdrawn at any time. So I don't know that it's the panacea that everyone's talking about, and I do think that people are incredibly overweight US sovereigns domestically, and I think when you overlay the fact that you've got undervalued equity and credit markets, I think it's a recipe for disaster.
Well, I'm amazed that you can even put a value on US equity markets on that basis, but it's another topic.
Yeah,
it's
and
another
we're out of
topic,
time.
and we're getting a wrap.
We can hold that thought. We can
Yes.
chat with you soon, hopefully again, Jim. Thanks so much, Jim Stanning from Fix.